On paper, procurement math looks simple. You buy a unit of raw material for $100, you sell the finished product for $150, and you book a $50 gross margin. But when the finance team closes the books at the end of the quarter, those projected $50 margins are often missing. The actual profits come in much lower, leaving leadership to investigate where the money went. That leakage happens during execution. When buyers manage thousands of daily transactions manually, they often miss negotiated volume discounts, overlook freight price hikes, or fail to account for third-party inspection fees. The price listed in a vendor's catalog rarely tells the full story when a procurement team relies on human memory to apply specific contract terms. Without an automated mathematical framework, the initial negotiated sticker price hides the actual cash outflow, leaving leadership unaware of the true cost of their inventory. This is solved by the pricing procedure, a calculation schema that serves as an automated financial engine. It activates the moment a buyer selects a specific vendor and material. This calculation sheet demonstrates the engine's first step. It pulls the gross price directly from pre-approved master data. By removing manual entry, the system eliminates the possibility of a simple keystroke error. Next, the engine checks for negotiated rules like volume-based scales. If a buyer increases an order from 50 to 150 units, the engine applies a 10% volume discount. The system executes this logic automatically. The buyer doesn't need to remember specific contract price breaks. This discount is subtracted from the gross amount, and the resulting total becomes the net price. Automating this step ensures that the terms negotiated by the C-suite are applied to every individual order placed by the purchasing team. Beyond the supplier's price, the company must account for the logistical variables of moving that material to the manufacturing facility. Next, delivery costs and inspection provisions are added to the net price. The system manages the financial routing, sending the net price to the supplier while diverting the freight provision to the transport company. Finally, the procedure assesses specific state taxes or import duties required based on the vendor's geographic location. By summing the gross price, discounts, freight, and taxes, the system arrives at the effective price. The effective price represents the fully loaded true cost to the company, calculated before the material even arrives at the loading dock. Capturing this data automatically eliminates the reliance on estimated costs and reveals your true actual margins. With an automated engine, procurement is no longer susceptible to manual data entry errors. By front-loading business logic into the pricing procedure, leadership ensures that every purchase order aligns perfectly with the terms of the master contract. Executives no longer have to wait for quarter-end invoices to clear before they understand the impact on their profit margins. The profitability of a purchase is visible the moment the order is placed. Replace manual spreadsheets and human memory with automated logic. A rigid pricing framework ensures that the value negotiated at the highest level reaches the bottom line.